Welcome back for another report on the oil market. Oil prices climbed to higher grounds in the most recent daily sessions, adding further to its upward momentum formed so far in September. The oil market is running through a rather interesting period at the moment, with lots of fundamentals driving trader decisions and the price action providing various setup opportunities. This report will overview the latest developments within the oil market and our personal views in parallel. We will be closing with WTI's technical analysis with important trends and levels identified. We start with the weekly oil market readings and the possible assumptions we can get by analyzing the price reaction. The most recent Baker Hughes oil rig count figure rose from previous 394 to 401, yet remains far from the August high of 410. Active oil rigs remain lower, thus demand in the US may have also been lower in the most recent weeks. On Tuesday, the AP weekly crude oil stockpiles indicated a large drawdown of minus 5.44 million barrels, which was much bigger than both expected and the previous figure. On Wednesday, the EIA crude oil inventories also displayed a large drawdown of minus 6.42 million barrels, intensifying further the upward momentum oil prices were in since the start of the current week. Large drawdowns tend to support oil prices, and this was displayed in the past days as WTI broke to a new monthly high price. During the start of the current week, the OPEC monthly report for September was released, providing valuable insights on the strings pulling the oil market at the moment. According to the official report, oil demand in Q3 of 2021 remains uplifted, reinforced by rising mobility and traveling activities. Simultaneously, fears over the potential impact of the Delta variant seem to be interfering with oil demand forecasts as we move into the ending season of the year. The uncertainty derived from this subject has led to downward adjustments to the fourth quarter estimates. Yet the group seems to support the notion for higher oil demand recovery in the first half of 2022. According to the report, NonOpec supply was revised downwards as supply was impacted mostly by outages in North America, with production disturbances at some platforms in the Gulf of Mexico and the Hurricane Ida disruption. However, with demand being on the rise in Q3 and considerable drawdowns displayed on a weekly basis, along with Hurricanes Ida and Nicholas disrupting production, these may have been the best circumstances for traders in a long time. In addition, Reuters in the past days stated energy companies operating in the Gulf of Mexico are still keeping 30% of crude oil production shut. That accounts approximately for 500,000 barrels, according to Regulator Bureau of Safety and Environmental Enforcement. The higher oil prices are having a negative impact on various countries as energy costs are pushing inflation higher. China, the biggest oil importer globally, has taken the initiative to use its strategic petroleum reserves as an attempt to better control commodity prices. This is a strategic action taken by the Chinese government that could be willing to make better use of domestic oil markets in case oil prices remain at rather high levels and could potentially impact the economy even more. Moving now to our technical analysis in WTI's 4-hour chart. At the moment, the commodity is in upward momentum, which is characterized by the ascending trend line placed on our chart. If this line is breached, then the momentum could be turning into a sideways motion with possible bearish tendencies. Yet if the upward momentum continues, then we could see WTI breaking above the 72.75 level and possibly test the 73.90, which was the highest price reached since 30th of July. Even higher, we note the 74.85 resistance. On the other hand, a correction lower could send WTI prices to the 71.40 support initially, while a decisive selling trend can also force prices lower to the 70.10 support level that was last tested on the 14th of September, making it very relevant. As our lowest support, we note the 69.25 level. The RSI indicator below our chart had been elevated above the 70 level on the 15th of September, yet was corrected a bit lower, with some possible take profits being enacted after the recent bullish action. In a personal opinion, due to the breach above levels previously seen in August and the start of September, We lean towards a bullish bias for the commodities price. Hope that you found the report useful, and from all of us here at IronFX, best wishes for solid trading.